2026 budget speech managed to be simultaneously dramatically different and much the same. It was much the same because in terms of macroeconomic policy and fiscal policy, there were no real surprises, pretty much as expected and pretty much in line with the medium-term budget we saw in November last year. Essentially, the fiscal metrics that were projected remain the same. The focus remains on debt stabilisation. The focus remains on faster economic growth and especially on stimulating infrastructure investment to lift economic growth over the medium term. We will see this year for the first time in 17 years that the debt to GDP ratio peaks, and starting next year it will start to come down. And with that, of course, also the debt service burden starts declining. That is the amount of money that the government spends on interest payments, which currently is about 21 cents in every rand that SARS collects goes towards interest payments. So that is broadly the same as it's been before. It's continuity, and I think investors will welcome it. What is very different compared to a year ago is just the broader market environment and the broader policy picture in South Africa. Finally, there is hope. There is a greater sense of optimism. We've seen government bond yields, which is the rate at which the government borrows, that has come down a lot over the last year. We've seen the rand stabilize and strengthen. We've seen credit ratings upgrades. We've seen the JSE rally. And what's really different when the minister presented this budget is the sense that all of these various pieces across different elements of policy making are finally clicking into place. So for instance, one of the reasons the bond yields came down so much is because we moved to a lower inflation target late last year, and the Reserve Bank has the credibility to deliver on that target over the medium term. We've also seen ongoing structural economic reforms driven by Operation Vulindlela, which of course is an entity of the presidency. We saw the combined government work to get us off the FATF grey list. So all of these various pieces are finally starting to click, and that is why the 2026 budget feels very different, and in a good way. From the point of view of taxpayers, also some good news in the sense that there is relief for bracket creep increases, and that is the idea that inflation tends to push you up into higher tax brackets. The previous year there was no relief. This time around there is some relief for taxpayers for bracket creep. There's also an increase in the medical aid tax credits. And I think importantly from a taxpayer's point of view is that the 20 billion rand that was penciled in last year has now been completely withdrawn. So no tax increases apart from the usual small increases in sin taxes, tobacco, alcohol, and also small increases in the fuel levy and the RAF levy. From the point of view of individual investors and our clients, I think notable is that there is the contribution limits to retirement annuities and tax-free savings were increased, so there's an opportunity to invest more and doing so in a tax-efficient way. But almost more importantly is the fact that the broader backdrop is now very conducive to taking advantage of increased investments. In other words, I think South African investors can have a lot more confidence now in putting money to work in the country, given that we have a better economic outlook, given that we have stable and sound monetary and fiscal policy, and given that the overall business climate is also starting to improve, which will ultimately translate into decent returns from asset classes, given also that valuations are still fairly attractive in South Africa. So all in all, the 2026 budget, I think, was positive. I think it's been well received by financial markets, although a lot of the good news was priced in. But I think it is definitely a key milestone on a longer journey to putting South Africa back on track, which will ultimately be good for investors, as well as for taxpayers and for society at large.